Welcome to the deep dive. Today, we're tackling the fundamentals of financial accounting.
Yeah, getting right into the core of it.
Think of this as your way to, quickly understand the language of business, maybe without cracking open those huge textbooks.
Mm.
We've pulled together insights from various places, including some solid building blocks from financial accounting, the basics, just to give you really good grounding.
And our mission here really is to boil down these core accounting principles so they're, well, not just clear, but genuinely useful,
Yeah,
actionable stuff.
exactly. We want to get past the jargon.
Right. Uncover what actually makes a difference.
Because you're here, you want to get up to speed efficiently. And we promise this won't feel like a dry lecture.
No, definitely not.
We're aiming for those aha moments, things that stick, showing the maybe surprising logic behind all the numbers. Okay, let's just dive straight in. The absolute bedrock, the accounting equation.
Yeah, you really can't overstate its importance. At its heart, financial accounting relies on this one equation: assets, liabilities, plus owner's equity.
Okay.
It's more than just a formula. It's like the DNA for understanding a company's financial health.
Right. So let's break that down. Simply assets. What are we talking about?
Assets are basically what the business owns. Tangible things like cash, equipment, buildings.
Stuff you can touch.
Yeah, mostly. But it also includes things you can't, like patents or even money that customers owe the business for things they've already received. That's accounts receivable.
Ah, okay.
Essentially, assets are resources the business controls that are expected to provide some future economic benefit.
Got it. Resources with value. And liabilities, then. And it sounds like what the business owes to others.
Precisely. Liabilities are the company's obligations to outsiders.
Okay.
Like bank loans, money owed to suppliers, that's accounts payable. Even things like customer deposits for services you haven't provided yet. That's often called deferred revenue. These are all outsider claims on the business's assets.
Okay. So assets are in the house. Liabilities are the IOUs to outsiders. So what's left? Owner's equity. The owner's slice of the pie.
That's a great way to put it. Owner's equity is the residual interest. What's left of the assets after you take away all the liabilities.
Yeah.
It's the owner's net claim.
Okay.
But here's another angle, which is quite interesting. You can almost think of owner's equity as a kind of internal debt. The business sort of owes this value back to its owners.
A debt to the owners. Huh. That's different.
Yeah, these are the insider claims versus the outsider claims of liabilities.
But it's not like a bank loan, right? No fixed repayment date.
No, not in that formal contractual way.
Mm-hmm.
But it does highlight that all the assets, everything the company owns, had to be financed somehow, either by outsiders lending money or by the owners putting money in or leaving profits in the business.
Okay, that makes sense. Liabilities are equity.
And looking at the balance between those two, liabilities versus equity, can tell you a lot about risk. A company loaded with debt might be riskier.
Sure, more vulnerable if things slow down. Okay, so how does this owner's equity figure? How does it change? Does it go up and down?
Oh, absolutely. It primarily increases in two ways. First, when the business makes a profit from its operations.
Right, earnings.
And second, if the owners invest more of their own money into the business.
Yeah.
New capital.
Okay. And decreases.
It goes down when the business makes a loss.
Mm-hmm.
And also, when owners take cash or other assets out of the business for their own use, we call those drawings.
So profits and investments build it up. Losses and drawings take it down. Is there like a formula for that too?
Yep, there is. We can show how the closing balance of owner's equity, OE, relates to the opening balance. You start with the opening capital, OC,
Right, yeah.
add any profit, P, made during the period, or subtract a loss, L, if there was one.
Mm-hmm.
Then add any new capital, NC, the owners put in, and finally subtract any drawings, D, the owners took out. So it looks like OE equals OC plus P, or NEL plus NCD.
OE equals OC plus PL plus NCD.
Got it. Can we see that with an example, maybe make it a bit more real?
Sure. Let's use that lottery winner scenario from the material. Say someone wins some money and puts a chunk into their existing business.
Okay.
Let's say at the end of the year, the owner's equity, OE, is £105,000. We know the opening capital, OC, was £85,000. The business made a profit, P, of £15,000. And the owner took out £2,400 in cash. Let's call that D1.
Right, so we know the start, the end, the profit, and some drawings.
Exactly. Now, what we want to figure out is the net effect of the lottery winnings put in, that's the new capital, NC, and maybe some goods the owner also took out for personal use. Let's call that D2. We don't know those individual numbers, just their combined effect.
Okay, so how do we find that missing piece, the lottery money minus the goods taken?
We just rearranged that formula we had. We want to find NC minus D2. So NC D2 equals OEOCP plus D1.
Okay, algebra. Just plug in the numbers. NCD2 equals 105,000 pounds minus 85,000 pounds plus 2,400 pounds.
Okay. Carry the 1. That comes out to 7,400 pounds.
Exactly. 7,400 pounds.
So what does that 7,400 pounds actually tell us?
It tells us that the amount of new capital injected from the lottery win was 7,400 pounds more than the value of any goods the owner also took out. It just shows how all these different things, profits, investments, drawings, feed into that final equity number. It's dynamic.
Yeah, that example really connects the dots. Okay, so all this info assets, liabilities, equity, profits, losses. How does a business actually report this formally? That's where financial statements come in, isn't it?
That's exactly right. Financial statements are the formal reports. They summarize everything. And while there are a few, we're going to focus on the big two, the main ones. The statement of financial position and the statement of profit or loss.
Okay, statement of financial position and statement of profit or loss.
Okay, statement of financial position and statement of profit or loss. I feel like I've heard older names for those. Balance sheet.
You absolutely have. The statement of financial position used to be called the balance sheet. Still is, quite often, informally.
And the statement of profit or loss was the profit and loss account, or P&L, or sometimes the income statement. The newer names are just a bit more descriptive, you know.
Makes sense. So what's the key difference between what these two statements show us?
Think of it like this. The statement of financial position is a snapshot. It shows the company's assets, liabilities, and equity at one specific moment in time, like, say, midnight on December 31st.
A picture of where things stand financially.
Exactly. Whereas the statement of profit or loss is more like a video. It shows performance over a period, a month, a quarter, a year. It lists the revenues earned during that time, subtracts the expenses incurred to get those revenues.
And tells you if you made a profit or loss for that period.
Precisely. Revenue minus expenses equals profit or loss. Performance over time.
Snapshot versus video. I like that. Okay, can we look at the structure of the statement of financial position, the balance sheet?
Sure. The material had that example for Mobile Center Ltd.
Mm-hmm.
Typically, you'll see assets listed first, often split into current assets.
Things expected to be used or turned to cash within a year, like cash itself, receivables, inventory.
Exactly. And non-current assets, the longer-term stuff like buildings, machinery, equipment, property, plant, and equipment, or PP&E.
Okay.
Then come liabilities, also usually split into current debts due within a year, like accounts payable,
Mm-hmm.
and non-current liabilities, long-term debt, like a mortgage or a big bank loan.
Right.
And finally, you have owner's equity, often just called capital for a small business. And you'll see the total assets always equals the total liabilities plus the total owner's equity. It has to balance.
Ah, hence the old name, balance sheet. It literally balances. Okay, now how do all the little day-to-day things, the transactions, actually feed into this big picture statement?
Good question. That Hollywood's Acting Training LTD example touches on this. Think about invoicing a client. What happens?
Well, the client owes you money now, so that's
Yeah.
an asset. Accounts receivable.
Right? Asset accounts receivable goes up. And because you earned it, your owner's equity also goes up through revenue.
Ah, okay. Two effects. What about getting a bank loan?
Cash, an asset, goes up because the money lands in your bank account.
Right.
But you also have a new liability, the loan payable, which goes up by the same amount.
Okay. Asset up, liability up. Balance maintained.
Every single transaction has this dual effect, keeping that fundamental equation, assets, liabilities plus equity, always in balance.
It's like a perpetual balancing act.
Hmm.
Okay, this leads us nicely into the mechanics of actually recording these transactions, debits and credits. I admit, this always felt a bit like a secret accounting language.
You're definitely not alone there. But honestly, debits and credits are just a system, a logical, standardized way to record the two sides of every transaction. It's what makes double-entry bookkeeping work.
Double entry because every transaction affects at least two accounts, keeping things balanced.
Precisely. And debits and credits are the rules for how we record those effects. Here's the fundamental rule to remember. Assets and expenses normally have debit balances.
Okay, assets, expenses, debit.
So, to increase an asset or an expense, you make a debit entry. To decrease them, you make a credit entry.
Got it. Increase with the debit, decrease with the credit.
Now, the other side, liabilities, owner's equity or capital, and income or revenue normally have credit balances.
Liabilities, equity, income, credit.
So to increase those, you make a credit entry. To decrease them, you make a debit entry.
Okay, debit increases assets, expenses.
Yep.
Credit increases liabilities, equity, income. That's the key right there, isn't it?
That's the absolute core of it. Nail that, and you've cracked a major part of the code.
Okay.
Now, when you actually record a transaction, there's a process. First, figure out what happened and which accounts are involved. Second, classify those accounts: asset, liability, equity, revenue, expense.
Right.
Third, apply the debit credit rules to show the increase or decrease. And critically, the total value of your debits must always equal the total value of your credits for that transaction. Always.
Debits equal credits every single time. So what happens if we mess up? If we debit when we should credit or use the wrong amount?
Errors happen, for sure. That's why we have checks and balances, like the trial balance.
The trial balance, what's that?
It's basically just a list of all the accounts in the ledger, with their final balances shown in 2 columns. One for debit balances, one for credit balances.
Okay.
You add up each column. If the total debits equal the total credits, the trial balance balances. It's a first check that mathematically the double entry seems to be working.
So if it balances, we're good. No errors.
Not necessarily, unfortunately. A balanced trial balance is good. It means debits equal credits overall, but errors can still hide in there.
Well, like, how can it balance but still be wrong?
Well, you could have debited the wrong asset account, say, equipment instead of vehicles, for the same amount. The totals would match, but the individual accounts would be wrong.
Okay.
Or you might have just completely forgotten to record a transaction altogether. Nothing debited, nothing credited, so the total's still balanced, but something's missing.
The material mentions some specific errors like that.
Yeah, some really good examples, like paying rent but recording it as a much smaller amount, the debit and credit balanced, but the amount was wrong.
Okay.
Or paying rent but accidentally debiting the insurance expense account instead of rent expense. Wrong account, but debit still equaled credit.
I see.
Or receiving cash from a customer but crediting accounts payable, money we owe suppliers, instead of accounts receivable, money owed to us, completely the wrong type of account.
Whoops.
Then there was the example of just missing an invoice entirely, no record. And finally, the owner taking cash, drawings, but debiting an expense account instead of the drawings account. All these things mess up the individual accounts, even if the trial balance totals happen to agree.
So the trial balance is just a first hurdle. You still need to check the details. How do you fix these mistakes once you find them?
You use what are called correcting journal entries. These are specific new debit and credit entries designed purely to fix the errors, to get the account balances back to where they should be.
Okay, an entry to undo the mistake and make it right.
Exactly. Like if rent was under-recorded, you'd make an entry to debit rent expense for the missing amount and credit cash or bank for the same amount, putting it right.
Gotcha. Can we just run through a few more quick everyday examples of debits and credits in action?
Absolutely. Let's take some from that January list. Say, transferring cash from your petty cash box to the business bank account.
Okay, moving money.
You debit the bank account, that asset is increasing, and you'd credit the cash account, that asset is decreasing. Asset up, asset down, balanced.
Right. What about selling some old office equipment for cash?
You debit cash, asset increasing, and you'd credit, well, probably an account like gain on disposal of assets, or maybe just other income. That's an income type account, increasing equity. So credit.
Okay, asset up, equity up via income, paying for advertising with a check.
You debit advertising expense increasing, and you credit the bank account asset decreasing.
Expense up, asset down. Buying a delivery van using a bank loan.
You debit the vehicle's account asset increasing. And you'd credit the bank loan payable liability account liability increasing.
Asset up, liability up. Okay, seeing it in different scenarios really helps cement those rules. Let's switch gears a bit. Inventory. For many businesses, that's a huge asset, right? But
Yeah.
tracking it, valuing it, seems complicated.
It definitely has its complexities, yeah.
Yeah.
The main goals are, 1, know how much stuff you have to sell, and 2, figure out accurately what it cost you when you actually sell it. Getting inventory right is critical for knowing your real profit and what your assets are truly worth.
Valuation. Yeah, how do you put a value on all that stock on the shelves, especially if prices change?
That's a key question. And there are specific rules. One really important one is the lower of cost or market value method, LCM.
Lower of cost or market value. Why lower? What's the logic?
It comes down to an accounting principle called conservatism, or prudence. Basically, it means don't overstate your assets or your profits. If you bought inventory for a certain cost, but now it's market value really, it's net realizable value, what you think you can sell it for, less selling costs has dropped below that cost. Then you have to value it at that lower market value on your books.
So you don't pretend it's worth more than you can realistically get for it.
Exactly. It prevents misleading people, especially if prices are falling. The example had those items A, B, and C.
Right. Item A cost £1,200, but now only worth £1,000, so you use the £1,000.
Correct. Item B costs £1,000 worth £1,100. You stick with the cost £1,000 because it's lower.
Okay. Cost is lower there.
Item C costs £850, now worth £600.
Yeah.
So you use the lower £600, add them up £1,000 plus £1,000 plus £600. The total inventory value under LCM is £2,600.
Even though the original cost was over £3,000.
Right. It's a more cautious, realistic valuation.
Makes sense. Avoids false optimism. Now, the text also mentioned different ways to track inventory perpetual versus periodic systems.
Yeah, two main approaches there. Perpetual means keeping constant, real-time track. Every time you buy inventory, the record updates. Every time you sell something, the record updates immediately, and you calculate the cost of that specific sale right then.
Sounds detailed. Continuous tracking.
It is. Lots of retailers use barcode scanners linked to systems like this. The periodic system is different.
How so?
With periodic, you don't update the inventory records with every transaction. You only figure out your inventory levels and your cost of goods sold, well, periodically, usually at the end of the month, quarter, or year.
So how do you know what you sold if you weren't tracking each sales cost?
You do a physical count of what's left on the shelves at the end of the period. That tells you your ending inventory.
Okay, you count what's left, then what?
Then you use a formula to calculate the cost of goods sold, COGS. You take your beginning inventory,
What you started with,
add all the purchases you made during the period,
what you bought.
and subtract the ending inventory you just counted.
Ah, start plus bought left, must have sold.
Exactly. Beginning inventory plus purchases ending inventory, cost of goods sold. That COGS number then goes on your statement of profit or loss against your sales.
Okay, that makes sense for the periodic system. Now, another complexity. What if you bought the same item multiple times during the period, but at different prices? How do you know which cost to use when calculating COGS?
Ah, good question. This is where inventory cost flow assumptions come in. The text introduced one major method, FIFO.
FIFO. First in, first out. Sounds like what it is.
It is. FIFO assumes that the first inventory items you bought, the oldest ones, are the first ones you sell.
Like groceries on a shelf sell the oldest milk first.
Pretty much that idea. So when you calculate your cost of goods sold, you use the costs of those earliest purchases. And the inventory that's left at the end, that's assumed to be made up of the items you bought most recently, valued at those newer costs.
Okay, oldest costs go to COGS. Newest costs stay in ending inventory. And this FIFO method, it links to that matching principle you mentioned.
It does, yes. The matching principle is fundamental. It says you should match expenses with the revenues they help generate in the same accounting period.
Okay.
So for inventory, the cost of the goods you actually sold, the COGS, needs to be matched against the sales revenue from those goods on the statement of profit or loss for that period.
Makes sense. Cost of sale matched with the sale itself.
And the cost of the inventory you didn't sell, that closing inventory value, that stays on the statement of financial position as an asset. Its cost will be matched against revenue in a future period whenever it eventually gets sold.
So how you value that closing inventory, it directly affects your profit number for this period, right?
Absolutely. If you value your closing inventory higher using the periodic formula, that means your cost of goods sold will be lower.
Lower COGS means higher gross profit.
Exactly. Higher profit reported for this period. But there's a catch for next period. That closing inventory figure becomes the opening inventory figure for the next period. So if you overstate it at this period, you're starting next period with an inflated opening inventory, which could lead to a higher COGS and lower profit next period.
Ah, so an error or valuation choice in 1 year can mess up the profit comparison between years.
Precisely. It can distort the trend.
Let's look at that Harrison Ford's LTD example. How did that show calculating cost of goods sold?
Okay, they gave us figures for opening inventory, purchases, closing inventory, and a couple of other things. Returns inwards and carriage outwards.
Right. What are those?
Returns inwards are goods returned by customers to us. Carriage outwards is the cost of shipping goods to customers.
Okay, so how do we calculate COGS?
Using the periodic formula, opening inventory plus purchases. Now, you also need to add carriage inwards if there's any. That's the cost of getting inventory to your business. That's part of the cost of the goods.
Okay, open plus purchases plus carriage in.
Then subtract closing inventory. That gives you COGS. Importantly, you don't include returns inwards or carriage outwards in the COGS calculation itself. Carriage outwards is a selling expense, separate from COGS.
Got it. And for Harrison Ford's, the number came out to 34,270.
That's the calculated COGS, yeah. 34,270.
Okay. Now those inventory error examples, XLTD and Dexons, they sounded pretty serious.
Oh, they really highlight the impact. XLTD understated its closing inventory 20 by 4 by 6,000 pounds.
So profit in 20 by 4 was too low.
Yes, but then that understated closing inventory became an understated opening inventory for 20 by 5.
Which means
COGS in 20 by 5 was understated, and therefore profit in 20 by 5 was overstated by 6,000 pounds. The error flipped the effect in the following year.
wow. So it made 20 by 4 look worse and 20 by 5 look better than they actually were, distorted the trend completely.
Exactly. The correction showed 20 by 5 wasn't actually as good as initially reported.
And the Dexons example was even bigger, €1 billion.
Yeah, massive scale. They overstated closing inventory in 20 by 6 by 1 billion. So profit looked way too high in 20 by 6.
And then in 20 by 7.
That overstated closing inventory became an overstated opening inventory in 20 by 7, which means COGS was too high in 20 by 7, and profit was understated by 1 billion. Again, a huge distortion over 2 years, making any analysis of trends totally meaningless until it was fixed.
Just shows how critical getting that inventory number right is. Okay, so we've done transactions, inventory. What about these final adjustments needed at the end of an accounting period?
Right, after all the day-to-day stuff is recorded, there are usually a few loose ends to tie up to make sure the statements are accurate for the period. These adjustments often involve accruals, prepayments, and dealing with potential bad debts.
Accruals and prepayments, these have to do with timing, right? When expenses or revenues cross over the end of the period.
Exactly. An accrual or accrued expense is an expense you've incurred, you've received the benefit, but you haven't paid for it yet by the period end. Maybe you haven't even got the bill.
Like wages for the last few days of December, paid in January.
Perfect example. The work was done in December, so the expense belongs in December's statement of profit or loss, even though the cash goes out later. You record the expense and also create a current liability, accrued wages payable.
Got it. Match the expense to the period it happened. What about prepayments?
Prepayments or prepaid expenses are the opposite. You've paid cash up front for something that will benefit future periods.
Like paying a whole year's insurance premium in January.
Exactly. You paid the cash now, but you haven't used up all 12 months of insurance coverage yet. Only the portion that relates to the current period is treated as an expense for this period.
So what happens to the rest of the payment?
The unused portion is recorded as a current asset on the statement of financial position, often called prepaid insurance. It represents a future benefit you've already paid for.
Ah, okay. An asset because you're owed future coverage. How do we record these with debits and credits quickly?
For an accrual, like the wages, you debit wages expense and credit accrued wages payable, a liability. For the prepaid insurance, initially, you might debit prepaid insurance, asset, and credit cash. Then, each period, you debit insurance expense for the amount used up and credit the prepaid insurance asset account to reduce it.
Okay, it's all about getting the expense recognized in the right time period. Now, the less happy stuff. Bad debts. What happens when customers don't pay?
Yeah, unfortunately it happens. When a business decides a specific customer debt is definitely not going to be collected, it needs to be written off.
Oh.
You make a journal entry, debit an account called bad debts expense. This reduces profit.
Yeah.
And you credit the customer's specific trade receivables account to remove the debt from their balance.
Okay, recognize the loss, clear the customer's account, but what if you're just worried about some debts, not certain they're bad yet?
That's where the allowance for doubtful debts comes in, also called a provision. This isn't about specific debts you know are bad, but an estimate of the total amount of your receivables that you think might become uncollectible in the future.
So it's like a general buffer for potential losses.
Exactly. You don't credit the individual customer accounts yet. Instead, you create a separate account called Allowance for Doubtful Debts. This is a contra-asset account.
Contra-asset, meaning it reduces the asset value?
Right. On the statement of financial position, you show your total trade receivables, then subtract this allowance to arrive at a net figure that represents what you realistically expect to collect.
How do you create or increase this allowance?
You Debit bad debts expense, just like writing off a specific debt, but you credit the allowance for doubtful debts account instead of the customer's account.
Okay, so the expense hits the profit now, but the allowance sits there, reducing the overall receivables value until specific debts are confirmed bad later.
Precisely. It's anticipating potential future losses based on experience or analysis. A key difference. Bad debt write-offs are for known uncollectible amounts. The allowance is for estimated future uncollectible amounts among the currently outstanding debts.
Got it. Bad, definite. Allowance, estimates. Okay, let's tackle one last area. Incomplete records. Sounds like a nightmare. What do you do when the books are messy or missing?
It's definitely a challenge, happens a lot with smaller businesses maybe, but yeah, there are ways accountants try to piece together the puzzle.
Where do you even begin if records are patchy?
Often you go back to that fundamental accounting equation and the changes in equity formula. OE equals OC plus P, or NHL plus NCD.
Ah, the one we started with. How does that help?
Well, if you can reliably determine some of those components, maybe you know the closing equity from the bank balance and assets and, drawings, but you don't know the opening capital or the profit, you can rearrange the formula to solve for the missing piece.
Like in that example where they found the opening capital.
Exactly. They knew closing equity, 25K, profit euro, no new capital euros and drawings, 9.5K. They rearranged to OC, East OE, PNC plus D.
So OC equals 25,000, 8,000 plus 9,500.
Which comes out to 26,500 for the opening capital. You work backwards from what you do know.
Clever. Using the core logic. What if the missing info is about sales or cost of goods sold?
Then you might be able to use gross profit margins or markups. If you know the typical relationship between sales and KGS for that business or industry, say, they usually make a 20% gross profit margin on sales. And you can figure out their total sales, perhaps some bank deposits. You can then calculate the estimated KGS.
Or vice versa. Like a Madonna example. Sales were 20K, gross profit was 4K.
Right. So sales 20K minus KGS must equal gross profit, 4K. Rearranging that, KGS must be 16,000 pounds.
Yeah.
20K, 4K, you derive one from the others if you know the relationship.
Okay, using profit percentages. What about figuring out total purchases or total credit sales if the invoices are missing?
That's where T accounts can be really useful, specifically for trade payables, suppliers, and trade receivables, customers.
How do T accounts help reconstruct things?
Take trade payables. If you know how much you owed suppliers at the start of the year, opening balance, and how much you owed them at the end, closing balance, and you know how much cash you actually pay them during the year from bank records, the missing piece that makes the T account balance must be the total amount of purchases you made on credit during the year. You can solve for it.
Ah, you use the beginning and in cash paid to figure out the credit purchases added in between.
Exactly. And you do the same logic for trade receivables, using opening balance, closing balance, and cash received from customers to figure out the total credit sales made during the year.
Like in the Fergie example, they figured out purchases were 59,800 and sales were 81,500 using this T account logic.
That's right. It helps reconstruct the flow of credit transactions when direct records are missing.
Okay, reconstructing credit. What if the issue is missing cash information? Like a business owner who deals mostly in cash and hasn't kept good track.
That's tougher. The approach usually involves setting up cash accounts, cash on hand, bank account, and trying to meticulously record all known cash inflows, receipts and outflows, payments you can verify.
Okay, capture everything you know for sure.
Then you see if the cash account makes sense or if there's an unexplained difference. A big leftover debit might suggest unrecorded cash sales. A big unexplained credit could mean unrecorded cash drawings by the owner, or maybe even something worse. You force it to balance and investigate the discrepancy.
Like balancing your own checkbook and trying to figure out where that extra 50 pounds came from or went. Financial detective work.
Pretty much, yeah. Trying to find the story behind the numbers, or lack thereof.
Wow. Well, this has been incredibly thorough, a real deep dive into these accounting basics. I feel like I actually have a much better handle on it now.
We definitely covered a lot of ground from that core accounting equation.
Assets, the O for rent, liabilities plus equity. Got it.
Through the main financial statements, the statement of financial position and profit or loss.
Snapshot and video.
The mechanics of debits and credits, which hopefully seem less like a secret code now.
Debit, assets, expenses up. Credit liabilities, equity, income up. Yep.
Then inventory valuation like FIFO and LCM, those crucial final adjustments like accruals and prepayments, and even how to tackle incomplete records.
And hopefully for everyone listening, you can see how getting these fundamentals really does give you a powerful shortcut. You're much better equipped now to be well informed about the financial health, the performance of pretty much any business.
Absolutely. You can look at a set of accounts and ask smarter questions, understand what's behind the numbers a bit more.
So here's a final thought, something to mull over. Considering everything we've discussed, especially things like valuation, estimates, judgment calls, and accounting, what's maybe one area in a company's financial reports that you think might often hide some surprising insights, or perhaps warrants a closer look if you really want to understand the true picture?
That's a good one to ponder. Could it be how they value intangible assets? Or maybe how they estimate future warranty claims? Lots to think about there.
Something to chew on. Maybe do a little digging yourself.
Definitely. Well, thanks for joining us on this deep dive into financial accounting basics.
Yeah, we really hope this has been helpful and maybe even a little bit enlightening.